monetary policy, goals, theories, rules, discretion, and implementation. Welcome to our 10th topic in this course, which is a discussion of monetary policy. Please read Chapter 10 in the book. In this lecture you will learn that monetary policy is determined by the central bank, but its long-term goals are generally established by government. Such is the case with the Federal Reserve's policy goals, which have been set by Congress. Moreover, monetary policies are implemented through the banking system. In this topic, you will learn 1. About the history of the central bank in the United States. 2. How the Federal Reserve's operational policy goals have been evolving. 3. How our star plays a role in monetary policy. 4. What the term structure of interest rates is and means. 5. How monetary policy affects the economy and inflation. 6. About some monetary theories. 7. How monetary theories have embraced rules of thumb for setting interest rates. 8. How the Federal Reserve is structured and how policy is implemented. 9. About the policy tools available for central banks. 10. About the role of large-scale asset purchases and sales. 11. How monetary policy has been impacted by market-based financing and may be affected by central bank digital currencies. And, finally, 12. How broader social issues are affected by monetary policy. Before we begin those discussions, it is useful to step back and keep in mind this quote by James Benford, who is the Executive Director for Data and Analytics Transformation and Chief Data Officer for the Bank of England, which is the United Kingdom's central bank. Although he was speaking about the United Kingdom, the message on data usage extends to most central banks around the world. Benford opined that data are the lifeblood of the central bank and analytics the beating heart behind their decisions. Indeed, this is true of how the Federal Reserve also operates. Benford further held that the central bank cannot take effective decisions to discharge its function without detailed information and expert analysis about the economy and financial system. It has always been thus, Benford said, right back to when the Bank of England was founded in 1694. Clearly, data analysis underlies how a central bank operates, including in the United States. Benford noted his favorite story about the Bank of England's early use of data in 1805. He described how the central bank installed a wind dial in its boardroom, which was linked to a weather vane on the bank's roof. He explained that back then, the weather was an important regular influence on the economy and that dial drove the bank's decisions on monetary policy. When the wind came in from the east, ships would be sailing up the Thames to unload their goods. The bank would then put more money in circulation, so traders could purchase goods as they were unloaded. If the wind came from the west, the bank would pull back excess money, to stop too much money chasing fewer goods, tempering inflation. Benford's point is well taken as he notes that over 200 years later, we talk of real-time dashboards driving decisions in the boardroom. The technology is different and there are a lot more data, but the intent is identical. So with this perspective, let's explore the many dimensions of U.S. monetary policy and operations. Our starting point is to explore the creation of the central bank in the United States. Our first question, therefore, is, what is the history and importance of a central bank in the United States? In the early days of this country, the Central Bank of England became a role model for the United States. Alexander Hamilton, the first Secretary of the U.S. Treasury, was influenced by the economic role played by the Bank of England as the government's banker and debt manager. Hamilton embraced the need in the U.S. for a similar central bank, but Thomas Jefferson, the U.S.'s first Secretary of State, was opposed to the idea. Jefferson argued that the Constitution did not grant the government the authority to establish corporations, including a national bank. But ultimately, Hamilton's persuasive arguments for the need of a central bank to President George Washington convinced the president of the wisdom of the idea. Despite the opposing voices, Hamilton's bill cleared both the House and the Senate after much debate. President Washington signed the bill into law in February 1791, which formed the Bank of the United States. The Bank of the United States was a quasi-governmental bank with private sector involvement. The Federal Reserve described the history of this first central bank as: the Bank of the United States started with capitalization of $10 million, $2 million of which was owned by the government and the remaining $8 million by private investors. The size of its capitalization made the bank not only the largest financial institution, but the largest corporation of any type in the new nation. The bank's sale of shares was the largest initial public offering, IPO, in the country to date. Many of the initial investors were foreign, a fact that did not sit well with many Americans, even though the foreign shareholders could not vote. The IPO did not offer shares for immediate delivery but rather subscriptions, or scrips, that acted as a down payment on the purchase of bank stock. When the bank's subscriptions went on sale in July 1791, they sold so quickly that many would-be investors were left out, prompting fierce bidding in the secondary market for scrips. The bank acted as the federal government's fiscal agent, collecting tax revenues, securing the government's funds, making loans to the government, transferring government deposits through the bank's branch network, and paying the government's bills. The bank also managed the U.S. Treasury's interest payments to European investors in U.S. government securities. Although the U.S. government, the largest shareholder, did not directly manage the bank, it did garner a portion of the bank's profits. The Treasury Secretary had the authority to inspect the bank's books, require statements of the bank's condition as frequently as once each week, and remove the government's deposits at any time for any reason. To avoid inflation and the appearance of impropriety, the bank was forbidden from buying U.S. government bonds. In addition to its activities on behalf of the government, the Bank of the United States also operated as a commercial bank, which meant it accepted deposits from the public and made loans to private citizens and businesses. Its banknotes, paper currency, most commonly entered circulation through the loan process. It extended more loans and issued more currency than any other bank in the nation because it was the largest financial institution in the United States and the only institution holding federal government deposits and possessing branches throughout the nation. Banknotes issued by the Bank of the United States were widely accepted throughout the country. And unlike notes issued by state banks, Bank of the United States notes were the only ones accepted as payment of federal taxes. Unlike modern central banks, the Bank of the United States did not set monetary policy as we know it today. It did not regulate or act as a lender of last resort for other financial institutions, and it did not hold their reserves. Nonetheless, its prominence as one of the largest corporations in America and its branch's broad geographic position in the emerging American economy allowed it to conduct a rudimentary monetary policy. The bank's notes, backed by substantial gold reserves, gave the country a relatively stable national currency. By managing its lending policies and the flow of funds through its accounts, the bank could, and did, alter the supply of money and credit in the economy and hence the level of interest rates charged to borrowers. This first central bank for the United States was successful in providing some financial stability and growth for the fledgling country. Although Congress approved the bank idea in 1791, the legislative body only made the central bank's charter provisional or temporary, and it had to be reviewed and renewed by 1811. The history of this institution, as described by the Federal Reserve, noted that discussions for renewing the bank's charter began in 1808, 3 years before it was set to expire. The Fed wrote that in 1808, the bank's shareholders asked Congress to extend the charter. In March 1809, Secretary of the Treasury Albert Gallatin recommended renewing the bank's charter. Congress let the matter languish until January 1810. At that time, the House gave the request for renewal a quick reading but took no action. Finally, in January 1811, both chambers of Congress engaged in a debate on whether to renew. Later that month, the House voted against renewal by just one vote. In February, Gallatin again recommended renewing the bank's charter. The Senate vote, however, resulted in a tie. The Vice President, George Clinton of New York, cast the tie-breaking vote, and the charter renewal was again defeated by one vote. By 1811, Many of those who had opposed the bank in 1790-91 still opposed it for the same reasons and said the charter should be allowed to expire. By this point, Alexander Hamilton was dead, killed in a duel with Aaron Burr, and his pro-bank Federalist Party was out of power, while the Democratic-Republican Party was in control. Furthermore, by 1811, the number of state banks had increased greatly, and those financial institutions feared both competition from a national bank and its power. Alas, in 1811, Congress reversed its position on the need for a central bank and did not renew the central bank's charter. A second Bank of the United States was formed by President Madison, who was not a supporter of the idea, but came to recognize the need of a national bank to help stabilize the banking system, facilitate public lending, and to establish a uniform national currency. In Madison's ultimate support for this Bank of the United States, he said that this bank could revive public credit, provide a national medium of circulation, and aid the Treasury by facilitating the indispensable anticipations of the revenue and by affording to the public more durable loans. Although this institution that was formed in 1816, and chartered for 20 years, its existence would face political infighting that led President Andrew Jackson to veto the bank's recharter. However, in the intervening years between the demise of the Bank of the United States and the creation of the Federal Reserve Bank in 1913, Congress and the U.S. Treasury began to see numerous advantages of a central bank. So, finally, Congress recognized the necessity for a central bank and passed the Federal Reserve Act of 1913, which created a permanent central bank for the United States. Now, let's watch this 4.5-minute video from the History Channel on the Second Bank of the United States. Politics inevitably doomed this version of our central bank.
1832, the last year of Andrew Jackson's first term, was a pivotal year in his presidency. After fighting petticoats, Indians, and secessionists, he suddenly faced his most daunting enemy, the Bank of the United States.
The bank war was absolutely the central political controversy of his administration.
The Bank War began in the summer of 1832, when Congress, led by Henry Clay, renewed the bank's charter, even though it wasn't due to expire until 1836. Clay pushed the bill through for political reasons and presented it to Jackson on the 4th of July.
It's not immediately clear that Andrew Jackson has a problem with the bank, but once Henry Clay involves himself in the bank recharter, then suddenly it becomes a battle royal that Jackson has to involve himself in.
Henry Clay was also running for president that year, and he was supported by the president of the Bank of the United States, a man named Nicholas Biddle. Both Clay and Biddle believed they could force Jackson to sign the bank bill. If he didn't, Clay would crush his bid for re-election. But the old general outflanked them.
He's told that there is a cabal between Biddle and Henry Clay, and once Jackson thinks of the bank in those terms, then this is something that absolutely has to be vanquished in his mind. It becomes, in his term, the hydra-headed monster.
He said to Van Buren, the bank is trying to kill me, but I will kill it.
Typical of Jackson, he personified the bank fight by waging war against one man, Nicholas Biddle.
Jackson saw Biddle not only as his own personal enemy, but the enemy of the people.
The United States of America wasn't big enough for both Andrew Jackson and Nicholas Biddle.
Jackson vetoed the bank bill, returning it with a simple yet powerful note, in which he stated, "The bill to continue the Bank of the United States was presented to me on the 4th of July. Having considered it with that solemn regard to the principles of the Constitution which the day was calculated to inspire, and come to the conclusion that it ought not to become a law, I herewith return it to the Senate, in which it originated, with my objections." Nicholas Biddle called Jackson's veto a manifesto of anarchy. Jackson called it his mandate for re-election.
Jackson saw this as an opportunity to strike out for the power of the ordinary citizen by smashing what he called the monster bank.
He saw it as an absolute mandate of the people that he was right and the bank was wrong.
In the end, Jackson's popularity won out. He crushed Clay in a landslide, then immediately moved on his mandate to close Biddle's bank.
The bank still had 4 years left on its existing charter, and Jackson said, "I don't want to wait 4 years."
In the summer of 1833, while Congress was in recess, Jackson ordered his Treasury Secretary to redirect federal deposits from the Bank of the United States to various state banks.
It was a very audacious move, in part because it wasn't even clear that what Jackson wanted to do was legal at all.
His first Secretary of the Treasury wouldn't do it. He replaced him. The second Secretary of the Treasury wouldn't do it either. He fired him. So he went through 3 Secretaries of the Treasury before he installed one who would withdraw the money the way he was told. And when that was done, Jackson's enemies absolutely went ballistic.
When Congress returned and found out what Jackson had done, they censured him for his actions. The first and only president to be censured. By 1836, the Bank of the United States was dead.
As just noted, Congress finally recognized the need to have a central bank in the early years of the 20th century. The history of the creation of the central bank is documented by the historian of the U.S. Senate and came about through 3 key events that followed the 1907 financial panic. In Martin Wolfson's book on financial crises, he noted that, quote, "In the 19th and early 20th centuries, financial crises occurred regularly in the United States, with particularly severe episodes in 1873 and 1893." Unquote. However, the eventual legislation for the Federal Reserve Board was set in motion by the financial crisis of 1907, which created bank failures, a stock market crash, and a credit crunch. Not surprisingly, maybe, liquidity concerns for the economy continue to be a major focus for the Federal Reserve even today, but the central bank today, at least, has a range of tools to restore stability in the financial system. The first of the 3 steps towards a permanent central bank for the United States started in 1908, when the Aldrich-Vreeland Act became law, and provided for emergency currency issuance because of the 1907 financial crisis. Moreover, it also established the National Monetary Commission to search for a long-term solution to the nation's banking and financial problems, and what was considered the inelastic currency of the United States. The second step was a secret meeting of bankers in November 1910 on Jekyll Island, Georgia. The meeting was organized by financiers and bankers who recognized the nation's need for a central bank and wanted to begin the process. Because they did not think the public would welcome a plan crafted in part by bankers, they made extraordinary efforts to keep the meeting secret, using only first names and telling others they were on a duck hunting trip. However, it was not until 1912 that the third step towards a central bank was initiated with the election of 1912, when Democrat Woodrow Wilson won the White House along with his party's majorities in both the U.S. House and Senate. The U.S. Senate historian observed, quote, "Even before his inauguration, President-elect Woodrow Wilson began encouraging congressional leaders to enact banking and currency reform. In March 1913, the Democratic Senate created its first Banking and Currency Committee, chaired by Oklahoma Senator Robert D. Owen. The House Banking Committee was chaired by Virginia Representative, and future Senator, Carter Glass. In June, President Wilson formally proposed creation of a government-run Federal Reserve System. The House took up the issue first and passed a bill in September, after which the Senate Banking Committee began holding hearings. The Senate historian further observed, quote, "On December 23, 1913, the Senate adopted the conference report by a vote of 43 to 25, with every Democrat present voting for the measure and all but 4 Republicans voting against it. 27 senators were paired or chose not to vote. Most senators immediately rushed to Union Station to catch trains home for the holidays, while the chief sponsors went to the White House. President Wilson signed the Glass-Owen Act at 6 p.m. He used 4 pens, then gave one to each of the leading sponsors. Wilson commented that he was not accustomed to using a series of pens. The Democratic whip, Senator J. Hamilton Lewis of Illinois, responded, "The bill itself was made in installments, Mr. President." "Yes," said Wilson, and very slowly. The Oval Office filled with cheers for what became the most lasting legislative accomplishment of the Wilson administration. Unquote. The main function of this new central bank was to provide for a more elastic currency, so to speak, that is to serve as the nation's bank, to provide liquidity to the banking system when needed, and to exercise supervisory authority over banks. Private sector banks were heavily involved with this new central bank, which is true even today. However, the 1913 legislation never set goals for monetary policy, only set up the institution to manage the monetary system. The history of the U.S. Central Bank demonstrates that it is a creation of Congress, and as a result Congress can set and alter, if it wishes, its monetary policy goals. And so it was when Congress passed the Federal Reserve Act of 1977, which set those monetary policy goals for the Federal Reserve. The legislation said, "The Board of Governors of the Federal Reserve System and the Federal Open Market Committee shall maintain long-run growth of the monetary and credit aggregates commensurate with the economy's long-run potential to increase production, so as to promote effectively the goals of maximum employment, stable prices, and moderate long-term interest rates." Later we will see how some members of Congress have pushed to alter the goals of the central bank to encompass social objectives as well. So, why does the Federal Reserve often discuss its dual mandate from Congress and not its triple mandate as the 1977 legislation actually said? The 1977 law clearly said that the goals of the Federal Reserve are to strive for maximum employment, stable prices, and moderate long-term interest rates. However, former Federal Reserve Board Governor Frederick Mishkin observed that, because long-term interest rates can remain low only in a stable macroeconomic environment, these goals are often referred to as the dual mandate. That is, the Federal Reserve seeks to promote the co-equal objectives of maximum employment and price stability. Thus, interest rates are a consequence of the other two mandates being successfully achieved. Finally, I should say that the Fed now is beginning to reference its triple mandate a little more, especially in its monetary policy reports. Okay. How does the central bank achieve price stability? Well, this comes down to having an inflation goal or target. Inflation targeting, a common practice in central banking today, aims to move the expected rate of inflation towards its target, regardless of its past levels. The idea of a firm inflation target has evolved. Today, the Federal Reserve's inflation target is more flexible. In 2020, the Federal Reserve recast its inflation targeting strategy from an ongoing goal of achieving a 2% inflation to what was dubbed a new framework that adopted a flexible average inflation targeting strategy, FAIT, that seeks to achieve inflation that averages 2% over time in order to ensure longer-term inflation expectations are well anchored at 2%. Under a FAIT strategy, appropriate monetary policy aims to achieve inflation moderately above 2% for some time to make up for shortfalls during a period when it has been running persistently below 2%. So, the Fed's current inflation strategy is now more tolerant of inflation running above, or below, the 2% target, just as long as it tends to balance out around the 2% mark over the long run. Previously, we discussed the pros and cons of different inflation measures. Which measure of inflation does the Federal Reserve target? The Federal Reserve targets two measures of inflation: 1, the Personal Consumption Expenditure Price Index, and 2, the Personal Consumption Expenditure Price Index less food and energy. Before moving ahead, ask yourself, why is the Fed's focus on the Personal Consumption Expenditure Price Index and not the CPI? Can you answer that question? If not, review our discussion of inflation measures. Additionally, ask yourself, why does the Fed target only consumer inflation, and not aggregate inflation in the economy as measured by, say, the GDP price index, This may be a harder question to answer. The more timely consumer price data may be one reason for that focus, but it is not totally clear otherwise. Why not target a more encompassing measure of inflation? With regard to the maximum employment objective, what measure of employment does the Federal Reserve target? Initially, the Fed focused on payroll employment as its employment target. However, on November 3, 2021, Federal Reserve Board Chair Jerome Powell opined on this question by saying, "Maximum employment is a broad-based and inclusive goal that's not directly measurable and changes over time due to various factors. You can't specify a specific goal. So, it's taking into account quite a broad range of things, and of course, employment, levels of employment, participation are a part of that. But in addition, there are other measures of what's going on in the labor market, like wages is a key measure of how tight the labor market is. The level of quits. The amount of job openings. The flows in and out of various states. So, we look at so many different things, and you make an overall judgment. With the data shifts in the inflation and jobs goals, are the Federal Reserve's mandates being blurred? Well, the answer to that is yes. There are critics of the Federal Reserve's shift in what is meant exactly by its mandates. And some of those critics are former Federal Reserve officials. Nonetheless, that is where it stands, and the Fed has a strategic goal of reviewing its monetary policy goals and implementations every 5 years to keep monetary policy effective. The Fed also relies on other theoretical measures to help guide its monetary policy, such as R-star. But, what is R-star? The theoretical concept of R-star is the short-term interest rate that would exist when the economy is at full employment and stable inflation, such that monetary policy is neither contractionary nor expansionary. This term is interchangeable with the long-run equilibrium interest, because it is the interest rate associated with long-run aggregate supply. It also is the natural rate, which is a concept proffered by economist Knut Wicksell, that there is a certain rate of interest on loans which is neutral in respect to commodity prices and tends neither to raise nor to lower them. Finally, it is also called the neutral rate or the long-term neutral rate. No matter what it is called, this interest rate measure is unobservable, but various statistical estimates exist. Is R-star really a short-term or long-term interest rate? The conventional approach is to think of R-star as a short-term policy rate of the central bank that exists when the economy is at full employment with real potential output. Are there empirical time series estimates of R-star? Yes, there are empirical estimates of R-star, based on research by Laubach and Williams and Holston, Laubach and Williams, and a few other economists. The New York Fed, which had running estimates for R-star, stopped updating them for a period in 2020, noting that owing to the extraordinary volatility in GDP related to the COVID-19 pandemic, their estimates became unreliable. However, in May 2023, the New York Fed recast its models and again began to report estimates of R-star. The Richmond Fed also publishes an alternative measure of R-star. This chart shows the New York and Richmond Fed estimates of R-star along with the CBO's estimate of real potential output growth. R-star is conceptual and unobservable and has been called different things. It has been described as the neutral rate or the equilibrium rate that exists in the steady-state economy when inflation is steady, and economic growth is at real potential output. It also has been suggested to be equivalent to the trend level of economic growth, which is considered by some as a reasonable proxy for the natural rate. Indeed, estimates of R-star equivalent to potential growth, as shown in the graph, were reasonably consistent with each other between the 1970s through about 2010, but thereafter the gap between estimates of R-star and real potential GDP growth grew consistently apart. Is this an empirical issue in the econometric estimates of R-star? Or, is it that R-star cannot really be equivalent to potential real growth? No one is sure. However, the statistical correlation between the estimated real potential GDP growth by the Congressional Budget Office and the R-star estimate by the New York Federal Reserve has been a very strong relationship with a correlation of 0.91 as measured between 1961 and early 2023. At the end of the day, there are plenty of critics of using our star to guide policymakers in setting monetary policy. However, the concept is well founded in economic theory and provides another benchmark, even if it is not used exclusively or adhered to firmly in setting monetary policy. So, this leads us to ask, why should we care about our star? One of the strongest arguments for its use has been offered by the Dallas Fed president. In a speech by former Dallas Federal Reserve Bank President Robert S. Kaplan on October 24, 2018, he provided an important rationale why the neutral rate of interest was important. He said, "Monetary policy is accommodative when the federal funds rate is below the neutral rate. When this is the case, economic slack will tend to diminish, the economy will tend to grow faster, the unemployment rate should decline and inflation should tend to rise. When the federal funds rate is above the neutral rate, monetary policy is restrictive. When this is the case, economic slack will tend to increase, economic growth will tend to slow, the unemployment rate should tend to rise and the rate of inflation should be more muted or decline. The challenge for the Federal Reserve is managing this process and getting the balance right." Federal Reserve officials publish their expectations for long-run real interest rates, as shown in this table from the Fed's Summary of Economic Projections report. The real Fed funds rate, which can be calculated from this table, is the Federal Reserve's consensus of our star. This graphic gives you some perspective on comparing the real federal funds rate and estimates of the neutral rate. As noted by the Dallas Fed, when the real federal funds rate is above the neutral rate that occurs when monetary policy is restrictive. When the real federal funds rate is below the neutral rate, monetary policy is deemed accommodative. However, judging the true neutral rate can be tricky since it is a theoretical concept subject to estimation. Okay, we have referred to monetary policy a lot, but what do we really mean by monetary policy? Simply put, monetary policy involves managing interest rates and credit conditions, which influences the level of economic activity and inflation. We already have mentioned some impacts of monetary policy on the economy, but how does monetary policy affect the macroeconomy? Most of the impact of monetary policy acts through aggregate demand. A little bit spills over to aggregate supply, through how the central bank's actions alter expectations and secondarily through the exchange rate channel. This chart is from the Central Bank of Mexico, showing how central bank actions filter through the economy. Note how the 5 channels impact aggregate demand and/or aggregate supply. This is important because it shows that monetary policy has a bigger impact on aggregate demand. The IMF offers some additional perspective on what are the typical channels through which monetary policy works. The IMF observes that monetary policy usually uses the short-term money market interest rate as its operational target. The money market rate is transmitted via financial markets to deposit and lending rates of credit institutions, and through them to the broader economy. The ability of the central bank to achieve its ultimate objectives, price, financial, and overall macroeconomic stability, hinges in part on the transmission of the policy rate to other interest rates. In turn, bank interest rates affect the macroeconomy through several related channels, especially the 1. Interest rate channel, 2. Cash flow channel, 3. Balance sheet channel, and 4. Banking channel. As noted in the Bank of Mexico diagram on the previous slide, it considered the exchange rate channel significant, as well. All of these channels are influences that economists have explored linking monetary policy to the real economy, but the lingering question is which channel has the greatest or the least impact on the economy. The answers to that question about which monetary policy channel has the greatest impact on the economy will clearly depend on a lot of factors. It will also depend on the level of interest rates themselves. A 2024 study of 30 European countries found that the pass-through of policy rate changes into both deposit and lending rates falls to zero once the policy rate becomes negative. This study also found that negative policy rates hurt bank profitability and conclude that negative rates are unlikely to be an effective tool for stimulating the economy. This is an important point since the Bank of Japan, for example, actually had negative interest rates to encourage spending. Moreover, this study found compelling early evidence that the pass-through, from a change in policy interest rates, has been smaller and slower to affect the economy compared to the past. Pass-through effects from interest rate changes are an issue that will continue to be explored by economists around the world since it is crucial to how effective monetary policy will be. If you want to explore the real interest rate picture further, you can explore those interest rate using Fred, as shown here. Note the periods of negative real rates in this graphic. Of course, the question of the pass-through effect is important, but another related question is, how long does it take for a monetary policy change in interest rates to affect the economy? Different studies have come up with a range of estimates of a monetary impact on real GDP, based on different background conditions and time horizons. However, it is fair to say that the typical impacts of a 100 basis point, or a 1 percentage point, increase in the federal funds rate will, over the course of the subsequent 4 quarters, reduce real GDP by between 0.25% and 0.50%. A similar sized impact ripples through the economy in the subsequent 4 quarters of year 2, but by the 3rd year the impact is nearly zero. The reverse holds for a decrease in the federal funds rate. Obviously, with the constant changes to the global financial system and evolving pass-through impacts of monetary policy, these estimates have to be updated regularly. Another question of how interest rates affect the economy is tied to the yield curve. What is the yield curve? The yield curve, also known as the term structure of interest rates, is the relationship, often shown graphically, between yields of similar quality bonds against their maturities, ranging from shortest to longest. This also highlights the issue of which interest rate is important for which lending activity. For example, it is often the case that business inventories are financed with short-term borrowing, but business investment of capital projects would be financed by long-term borrowing. What is the normal shape of the yield curve? The normal shape of the yield curve is upward sloping, because it embodies the idea that further out in time that the risks of holding an asset are higher, that is the risk premium, which should be compensated for by a higher interest rate. The graph here demonstrates the normal shape of the U.S. Treasury yield curve. One of the things about the yield curve is that it is not always normally shaped. At times, the yield curve is inverted. So, what does it mean that the interest rate yield curve is inverted? When short-term maturities of similar quality bonds, such as the U.S. Treasury securities, are above the longer-term maturities, the yield curve is said to be inverted. As a side note, this graphic and the previous one show the U.S. Treasury bill and bond yield for different durations. These are the so-called risk-free interest rates, since they are issued by the federal government. However, yield curves can exist for other types of debt, such as corporate debt by the duration of the lending. Corporate debt is not risk-free debt since corporations can go bankrupt. Why does the yield curve invert? An inversion of the term structure of interest rates can occur either from the long end or short end of the term structure. Also, as the last slide demonstrated, the inversion may not be across every duration. If long-term bond investors expect that current long-term interest rates are likely to decline, money flows into those long-term assets to lock in the higher rates, which cause long-term yields to decline. An inverted yield curve occurring in the long end of the term structure is often followed by an economic slowdown or an outright recession, and ultimately, if the slowdown or recession materializes, lower interest rates along all maturity durations of the yield curve. If the Fed is raising short-term interest rates, This also may cause an inversion in the yield curve as long-term investors at some point may anticipate an economic slowdown causing the Fed to reverse that higher interest rate policy. With central bank implementation of LSAPs, which is a quantitative ease, this can put downward pressure on the yields of longer maturity assets. When the inversion is only to the mid-range durations, say 2-year to 5-year debt instruments, and the longer-term debt yields do not invert, this implies the financial markets only anticipate higher inflation and interest rates in the next 2 to 5 years, say, and not beyond. Hence, there is only a partial inversion of the term structure. Financial markets often assume that an inverted yield curve is a sign of an upcoming recession, because that pattern has been a reliable indicator since the 1960s. How does the yield curve change over the business cycle? A steep yield curve generally occurs at the beginning of an economic expansion, as long-term interest rates tend to edge up faster than short-term interest rates that are anchored by the central bank's monetary policy. This may be best viewed as the difference between a long-term and short-term interest rate, such as the difference between the 10-year U.S. Treasury note yield and the 3-month U.S. Treasury bill rate. As the economic expansion matures, and typically inflation pressures build, short-term interest rates begin to rise, nudged up by the central bank to guide the economy towards sustainable growth, which narrows the spread between the long-term and short-term rates. This chart shows the spread between the 10-year U.S. Treasury yield minus the 3-month U.S. Treasury bill rate, which is one spread that shows inversion of the yield curve, has signaled recession since the 1960s. Now, let's return to some monetary theory. In particular, what is the quantity theory of money? The quantity theory of money is a framework suggested by classical economists to link economic activity, inflation, and the money supply. American economist Irving Fisher gave a clear exposition of this theory in his influential book, The Purchasing Power of Money, published in 1911. Fisher's formulation of the quantity theory of money equated it with the equation of exchange. The equation of exchange is the relationship of the money supply times the velocity of money equals the price level times the quantity of output, also known as nominal GDP, and is written M times V equals P times Q, where M, Q, and P, respectively, denote measures of the nominal quantity of money, real transactions or physical output per period, and the price level, with V then being the corresponding monetary velocity. Classical economists, who held the view that prices and wages were flexible, argued that this framework suggested that goods, services, and factor prices, P, would fully adjust to the level that equates the supply and demand for a particular good or service, Q, in the long run, on the assumption that velocity was relatively fixed. But, alas, velocity is not fixed, though in the 1960s there was a relatively narrow band for M2 velocity, which allowed the monetarist movement that believed in this relationship to flourish. The changing velocity of money ultimately led to the diminished popularity of monetarist theories, which morphed into a new framework. If you are interested in why this relationship seemingly has broken down, please see the advanced question number 350 in the textbook. Generally, there are two lines of argument. 1. Financial innovation that speeds up money growth through demand deposit creation relative to GDP growth. Then velocity will decline. The prima facie evidence for this is that between 1960 and 1990, the mean and the median year-over-year quarterly growth in nominal GDP averaged about the same as the pace of M2 growth, around 8%. However, between 1990 and 2023, M2 growth, on average, was 1 percentage point faster than nominal GDP growth, that is 4.8% versus 5.9%. Then the arithmetic would suggest that velocity, during the 1960 to 1990 period grew, on average by 0.1% per quarter, but between 1990 and 2023 the pace has been declining at an average pace of 0.9% per quarter. The alternative view, and less commonly held view, is tied to Richard Werner's reinterpretation of this theory based on the original intent of the theory to measure all transactions, and not just GDP, which is final demand expenditures only. This leads to Werner's quantity theory of credit variant on this, which he argues better explains the concept and is more empirically accurate. Although I have attempted to evaluate and apply the Werner idea for the United States, I was unable to find it more accurate. Nonetheless, the general consensus remains that the quantity theory of money simply is not an accurate description of how the monetary and real sides of the economy relate. This chart shows the velocity of M2 that was described in the prior slide. So, what do we really mean by the term the velocity of money? The velocity of money is the frequency at which one unit of currency, M1 or M2, for example, is used to purchase domestically produced goods and services within a given time period. This means the number of times a dollar turns over or is used to purchase goods and services during a given period of time. Velocity of money is calculated as nominal GDP divided by the monetary aggregate. Okay, if monetary theories are lacking strong empirical support to guide policy, then what is helping to fill the gap? As monetary theories became more empirically challenged, rules of thumb began to fill in the void. These rules offer systematic and pragmatic monetary policy implementation. For example, the European Central Bank's monetary approach has been described as rule-based, but not rule-bound. The classic monetary policy rule that combines economic information to guide interest rates was suggested by Professor Taylor. So, what is the Taylor rule for setting the federal funds rate? One of the most quoted rules for setting monetary policy was published in 1993 by John Taylor, an economist from Stanford University. The Taylor rule is a simple equation, essentially, a rule of thumb, that is intended to describe the interest rate decisions of the Federal Reserve's Federal Open Market Committee, FOMC. The Taylor rule states that the short-term interest rate should be determined according to three factors. 1. Where actual inflation is relative to the targeted level that the Fed wishes to achieve. 2. How far economic activity is above or below its full employment level, actual real GDP versus potential, and 3. What the level of the short-term interest rate, R*, is that would be consistent with full employment. Taylor argued that the Federal Reserve should set its policy rate in the following manner. Policy rate, which is the federal funds rate, should equal 2 plus inflation plus half times inflation minus 2 plus half times real output minus potential output. The policy rate is the federal funds rate. The initial 2 represents an estimate of the neutral interest rate. Inflation is the growth rate in the PCE price index. Real output is real GDP growth rate. And potential output is real potential GDP growth rate. There is no consensus about the size of the coefficients in the policy rule. Taylor assumed that the 2% figure for the target rate of inflation, which has become the standard, and half seemed right for the coefficient of the GDP gap, and 2% for the real funds rate, or neutral rate, was thought reasonable by Taylor. The rule recommends a relatively high federal funds rate when monetary policy is tight, and a relatively low federal funds rate when monetary policy is easy. No rule of thumb is a perfect guide for policy, since the original Taylor rule would suggest negative interest rates during the global financial crisis, and during the COVID-19 pandemic. The original Taylor rule is shown here with the actual federal funds rate. Notice, as previously said, it is not perfect and even would have suggested negative interest rates in the aftermath of the 2008 recession and the 2020 pandemic-induced recession. However, since the original work, there have been numerous other variants on this rule of thumb offered by researchers, including those at the Federal Reserve. Some of the other variants eliminate negative interest rates and others adjust for a lower natural rate of interest. But you should recognize that this original Taylor rule and some of the other variants still incorporate theoretical concepts and/or goals. What is the value and drawback of monetary policy rules? St. Louis Federal Reserve Bank President James Bullard argued, monetary policy rules are useful because they yield a recommended level for the policy rate as a function of current conditions in the economy. And this helps set a baseline for the monetary policy debate. Additionally, Milton Friedman felt that when the Fed follows a discretionary policy, the policy tends to be implemented too slowly, thus a policy rule might be helpful to accelerate the reaction. Although the Federal Reserve notes that simple monetary policy rules, which relate a policy interest rate to a small number of other economic variables, can provide useful guidance to policymakers, they can be problematic since they do not take into account a broader range of circumstances, and for this reason discretionary monetary policy is vital. Let's move ahead to thinking about today's role for a central bank. What is it? A central bank, such as the Federal Reserve, is responsible for implementing monetary policy, promoting stability in the financial system, and functions as the lender of last resort, and to provide banking services for commercial banks and the federal government. What is meant by the lender of last resort? The term lender of last resort implies that the central bank will provide emergency loans to financial institutions during a financial crisis. In essence, the central bank is there to provide liquidity to financial institutions and the system when there is some crisis. Now let's explore the structure of the Federal Reserve. How is the Federal Reserve System structured? The Federal Reserve, Fed, is structured as a regional system, with elements of public and private oversight. This system is under the Board of Governors of the Federal Reserve System, headquartered in Washington, D.C. The board has 7 members, each of which serves a maximum term of 14 years or the remainder of an unexpired term. Each governor is appointed by the President of the United States and confirmed by the Senate. The chairman, who must be a member of the Board of Governors, serves a 4-year, renewable term. The system is comprised of 12 regional Federal Reserve banks, each of which is responsible for supporting the commercial banks and economy generally in its district. This map shows the location of the 12 regional Federal Reserve banks. Remember that the selection of those locations for reserve banks was set in 1913 based on business centers at that time. Moreover, the regional reserve banks originally were important centers for processing paper checks. Today, that function has gone electronic and there is no longer the same need to have regional processing. The need for regional banks is lessened today but serves more as local information gathering hubs. What is the Federal Open Market Committee of the Federal Reserve System? The Federal Open Market Committee, FOMC, is the monetary policy arm of the Federal Reserve Board. The FOMC usually regularly meets 8 times a year, but can have special meetings, if warranted. The FOMC consists of 7 members of the Board of Governors, the President of the Federal Reserve Bank of New York, since the NY Fed executes FOMC decisions, and the presidents of 4 other Federal Reserve banks, on a rotating basis. The chairman of the Board of Governors presides as the FOMC chairman. How does the FOMC set interest rates? The FOMC, along with the Federal Reserve Board itself, currently implements monetary policy changes through administered interest rates, the federal funds rate, its short-term policy interest rate, the interest rate paid by the Fed on reserve balances, and the overnight reverse repurchase agreement interest rate. This is supplemented by changes in the discount rate, through open market operations, and several other policy instruments it has available to impact liquidity in the economy. The chart on this slide shows how the FOMC, working through the New York Fed, implements an interest rate setting policy using a band around the Fed funds rate, in what is known as an ample reserves environment. That means that its balance sheet basically is bloated due to its quantitative easing bouts associated with the 2008 recession and the 2020 pandemic. What is meant by open market operations? Open market operations, by the Federal Reserve, are asset purchases or sales that occur for three reasons. 1. To maintain ample levels of banking system reserves, which also supports interest rate control, through the Federal Reserve's floor and subfloor interest rate bands, around the federal funds rate. 2. To affect financial conditions, that is, through a quantitative easing or tightening, and 3. To smooth out market disruptions. The New York Federal Reserve Bank's trading desk manages asset purchases or sales for the Federal Reserve System, as directed by the FOMC, by executing trades in the fixed income market with member banks to purchase or sell bonds, such as Treasury securities and agency mortgage-backed securities, MBS. At the bottom of the slide are open market operations in a nutshell. When the Fed is buying securities, that will boost bank reserves, which will boost the monetary base, and in turn will lower interest rates or boosts asset prices. On the other hand, when the Fed is selling securities, that will shrink bank reserves, which will shrink the monetary base, and in turn will raise interest rates or lower asset prices. This is how the Fed will add or reduce liquidity in the banking system. Why is it called open market operations? It is termed open market operations because the price of securities that are purchased or sold by the Fed are determined by competitive bidding among the banks. The Fed does business with its member banks, which are called primary dealers, of which today there are 24. Primary dealers include U.S.-based and foreign-based banks with a United States branch. Some of the primary dealers are Bank of America Securities, BMO Capital Markets, Citigroup Global Markets, Goldman Sachs, Deutsche Bank Securities, Nomura Securities International, and Wells Fargo Securities, to name a few. A primary dealer functions as a trading party of the New York Fed in its implementation of monetary policy. Remember that the Federal Reserve System implements its open market operations through its New York branch. Okay, we have talked about the Fed funds rate as the Fed's policy rate. But what actually is meant by the federal funds rate? The federal funds rate is the short-term interest rate, controlled by the Federal Reserve, at which depository institutions lend reserve balances to other depository institutions overnight. How are open market operations performed? Open market operations, OMO, operate through the banking system, the same way as any deposit or withdrawal from the private sector, which adds to or subtracts from bank reserves, but with a bigger bang. Open market operations are conducted by the New York Federal Reserve Bank under instructions from the FOMC. The key role of OMO is to provide adequate reserves for the banking system, irrespective of a change in monetary policy. This means the Fed economists need to estimate the banking system's daily liquidity need and adjust reserves accordingly. There are lots of reasons why reserve needs change daily based on seasonal needs, tax payments, quarterly government bond refunding purchases, etc. This activity is not related to policy changes. However, OMO are also used to build up or reduce the size of the Federal Reserve's balance sheet, that is, a quantitative easing or quantitative tightening or normalization. Historically, OMO is how typical monetary policy changes were implemented. What are the Federal Reserve's full range of monetary policy tools? The full range of Federal Reserve policy tools, today, include the federal funds rate, which was just mentioned, the discount rate, the interest rate charged by the central bank on the loans that it gives to other commercial banks. It is set by the Federal Reserve Board, not the FOMC, and any change must be requested by a regional Federal Reserve Bank. The rate of interest on reserve balances. The reserve requirement. Although still a policy tool, the reserve requirement is now set at 0, and practically has been superseded largely for financial institutions by the Basel III liquidity requirements, where banks are subject to a liquidity coverage ratio, LCR. Banks are required to maintain a stock of high-quality and liquid assets as a buffer that is sufficient to always cover potential net cumulative cash outflows during a 30-day period. In the United States, the Office of the Comptroller of the Currency, OCC, the Board of Governors of the Federal Reserve System, and the Federal Deposit Insurance Corporation, FDIC, adopted a liquidity coverage ratio rule, or the LCR rule, in September 2014 that implements a quantitative liquidity requirement consistent with the standard established by the Basel Committee on Banking Supervision. The original reserve requirement and the liquidity coverage ratio are quite similar in their banking objective, which is to provide banks with a cushion or buffer for cash outflows. Both the reserve requirement and the liquidity coverage ratio effectively require liquid assets to be held against certain classes of liabilities and lines of credit. However, a reserve requirement, if used, is set by the oversight banking authority of a country, while the liquidity coverage ratio is set by the Basel III international agreement developed by the Basel Committee on Banking Supervision, which is a committee set up by the Bank for International Settlements. Large-scale asset purchases, or LSAPs, and sales, also referred to as balance sheet policy. Yield curve control, which will be discussed shortly. Direct lending facilities. Forward guidance. This is basically Fed talk that informs and guides market participants about Federal Reserve thinking and potential actions. Some of these policy instruments in the Fed's toolkit are no longer used or have not been used, such as yield curve control, where the Federal Reserve could purposefully impact both short-term and long-term interest through its holdings of long-term assets. The Bank of Japan uses yield curve control. The Bank of Japan also is the only central bank that holds domestic stock as ETFs, exchange-traded funds, a basket of securities that mirror market movement and not individual stocks. What is meant by large-scale asset purchases or sales by the central bank? Large-scale asset purchases, which are more commonly referred to as a quantitative ease, occur when a central bank purchases long-term government and private mortgage-backed securities to make credit available to the economy in hopes of stimulating aggregate demand. The reverse of this process, that is sales of long-term securities, is dubbed a quantitative tightening, QT, or normalization. What is the history of the term quantitative ease? In a July 2013 newsletter by the UK's Royal Economic Society, Richard Werner described the history of the term quantitative ease, based on his 1995 research on the Japanese monetary system. Werner wrote, "Since the expression credit creation was considered difficult to understand in Japanese, he prefaced the standard Japanese expression for monetary stimulation, monetary easing or easing, with the word quantitative, to declare that quantitative easing, defined as credit creation for GDP transactions, would create a recovery." Werner's original discussion of the concept appeared in the Nikkei newspaper and was based on his ongoing economic research, which embraced the conceptual and empirical foundation that money is credit. Was the 2020 quantitative ease globally due to the pandemic? Absolutely. These graphs highlight the surge in central bank assets among some of the key global economies because of massive liquidity injections into their respective banking systems. This graph shows a sharp upturn in 2020 for the Central Bank of Japan. So too with the Bank of Canada, which also has unwound its asset build-up faster than most central banks. The European Central Bank assets soared in 2020 through 2022 and are being unwound now. The Federal Reserve surged its assets due to the COVID-19 pandemic and has been gradually unwinding its surge. All of the major central banks have responded similarly to the 2020 pandemic and its impact on their economies. When was a quantitative ease strategy first used? The Bank of Japan was the first central bank to implement a quantitative ease in 2001. How much of an interest rate impact on long-term interest rate assets did the Federal Reserve's quantitative ease have in the 2008 episode from QE1 through QE3? The 3 bouts of quantitative easing in 2008 through 2012, which added almost $3 trillion of liquidity to the banking system, was estimated by the NY Fed only through QE2 to have reduced the 10-year Treasury yield by between 30 to 100 basis points, and probably at the higher end of that range and above, accounting for the QE3 quantitative ease. How does yield curve control work? Although the Federal Reserve has not embraced yield curve control at this point in time, it is employed by the Bank of Japan, though its new Bank of Japan Governor Kazuo Ueda wants to get rid of the cap on long-term bonds. However, this strategy may find greater acceptance globally over time. Essentially, there are 4 yield curve control strategies that might be employed by a central bank. Those are targeting the level of a short-term or long-term interest rate, the change in the level of a short-term or long-term interest rate, the spread between a long-term and short-term interest rate, or the change in the slope of the spread between the long-term and short-term interest rate. Many of these strategies have not been fully explored theoretically or practically. This chart shows the 4 options for yield curve control. Notice the 4 options. 2 operate on just the level of the long-term or short-term rates. The other set operates on the shape of the yield curve. With the growth of market-based financing through shadow banking, rather than traditional bank financing, has monetary policy been diminished? No. A European central bank study found that its monetary policy actions through its policy interest rates remain a powerful policy instrument, also in a world in which market-based finance has expanded measurably. Obviously, this is strategically important given the importance of the shadow banking industry. One of the new financial instruments being developed by central bankers around the world is the central bank digital currency. What are the benefits of central bank digital currencies, CBDC, for central banks? As of early 2024, the Bahamas, Jamaica, and Nigeria have already introduced CBDCs. And more than 100 countries are in the exploration stage, including the United States. Central bankers in Brazil, China, the Euro area, India, and the United Kingdom are at the forefront for the next round of implementation. Generally, it is argued that CBDC could create a higher degree of financial inclusion, with more people having access to digital currency, and that would make monetary policy more effective, since it would be able to reach more parts of the economy. Additionally, the CBDC would provide more information for the central bank where the money is going and where debt may be accumulating. It is also argued that CBDC could eliminate the effective lower bound on interest rates, with the demise of traditional paper and coin currency. What are the concerns of central bank digital currencies, CBDC, for central banks? 2 major concerns about the use of CBDC are: if consumers and businesses use CBDC, why would they need to use a commercial bank? Would this then weaken the maturity and liquidity transformation that banks engage in to make a profit? Will there be acceptance of CBDC given that users will lose the anonymity inherent in using cash for purchases? Time will tell. Increasingly, monetary policy is being drawn into social objectives for the country by politicians around the world. Should the U.S. monetary policy goals of high employment and low inflation be expanded to include social objectives? In thinking about the role and impact of monetary policy on income inequality, the Bank of England noted that a monetary expansion would tend to benefit 1. Financial market participants, 2. Households whose financial liabilities exceed their assets, 3. Borrowers, and 4. Households that are more exposed to unemployment. On the other hand, a monetary policy expansion would likely harm 1. Low-income households vulnerable to inflation, 2. Households with short-term assets, and 3. Savers. Generally, the thinking is that a monetary expansion would likely lead to more inflation. Policymakers have been aware of these distributional impacts. Witness, for example, the former president of the Kansas City Federal Reserve Thomas Hoenig, who as a FOMC member opposed the quantitative easing policy in 2008, which he feared would lead to inflation but also would have undesirable allocative impacts on the economy. By allocative impacts, Hoenig argued that the Fed's quantitative ease policy would encourage financial market speculation, cause asset prices to rise, and shift wealth to the rich, who owned more of those financial assets. So, is monetary policy the right tool to address income distribution issues in the economy? In 2016, then Bank of England's Governor Mark Carney, who also was previously a former head of the Bank of Canada, rhetorically asked, "Has monetary policy robbed savers to pay borrowers, and acted as Robin Hood in reverse?" He answered with a solid no, and went on to explain that all monetary policy has distributional effects, but it is rightly the role of elected governments to take measures to offset some or all of those distributional effects, not the monetary authorities. But still, monetary policymakers need to be mindful of how monetary policy can affect income inequity. To this end, a 2018 BOE study opined that a monetary policymaker needs to understand the distributional consequences of its policy decisions. The study suggested that whether monetary policy should be responsible for income distribution equity has a lot to do with how effective it might be in this non-traditional role, which historically has been the realm of fiscal policy. Is monetary policy the right tool to address racial and economic equity in the economy? The Federal Reserve's monetary policy is quite limited in its ability to address racial and economic equity in the economy, which often is viewed as a role for fiscal policy. However, the Federal Reserve's regulatory role over the banking industry may be more likely to effectuate that social objective. Nonetheless, the U.S. Congress has advanced this role for the Federal Reserve. On June 15, 2022, with a vote of 215 to 207, the U.S. House of Representatives passed, with the White House's support, H.R. 2543, Federal Reserve Racial and Economic Equity Act. However, the bill never became law. Nonetheless, hoisting social objectives on a central bank may be a result of more sharply divided governments in the United States and in many countries around the world, and, as a result, politicians attempting to shift that role to monetary authorities because of the difficulty of trying to address perceived social issues appropriately through fiscal policy. We have now concluded this discussion of monetary policy. Take a moment to consider these thought questions. Today, monetary policy is influenced by the new Keynesian model, which is an evolution of the model we covered in Chapter 8. But it is still narrowly focused on the traditional role for a central bank. Do you think that the central bank role should be expanded? Is the post-COVID-19 pandemic inflation globally due to the ballooning of central bank assets around the world? At the time, was that the right strategy or not? Obviously, there is a lot of debate on both sides of these issues depending on the theories embraced and one's political objectives, so your thinking cannot be wrong no matter how you answer these questions.